Have you ever wondered why a high percentage of Forex traders fail despite the abundance of strategies, tools, and resources available? It's a question that has puzzled many. You see, a common misconception in the world of trading is that success is all about making the right predictions. But is it really? The answer might surprise you. In the arena of Forex trading, it's not just about predicting the movement of currency pairs. That's merely a part of the equation. The real game changer? It's the concept of probabilities. Probabilities, you ask? Yes, probabilities. You see, trading is a game of chances, a game of probabilities. It's about understanding that each trade is independent of the other. It's about knowing that even a strategy that works 90% of the time can fail 10% of the time. So, let's debunk the myth. Trading isn't about being right or wrong. It's not about being right or wrong, but about understanding the probabilities at play. Let's delve into the story of John, a novice trader who, like many others, fell into the trap of misunderstanding probabilities. John, full of enthusiasm and dreams of financial freedom, entered the world of Forex trading with stars in his eyes. He was eager to capitalize on the opportunities the global market presented, but little did he know the journey ahead was not all glitz and glamour. John started off on the right foot, studying charts, patterns, and indicators. He was fueled by the thrill of potential gains and the excitement of being part of the dynamic Forex market. However, as the weeks turned to months, his initial excitement began to wane, replaced by frustration and confusion. His trades, initially successful, started to fail more often than not. He couldn't understand why his well-researched predictions were going awry. He had painstakingly analyzed market trends, made careful predictions, but the market seemed to have a mind of its own, refusing to align with his expectations. John's downfall was his reliance on predictions. He believed that trading was about predicting the market's next move with certainty. He was caught in the illusion that every trade should be a winner if he could just predict the market accurately. But Forex trading isn't about certainty, it's about probabilities. He failed to understand that trading is a game of odds. It's about making informed decisions based on the likelihood of certain outcomes, not about making perfect predictions. Each trade is merely a single event in a series of many. It's like flipping a coin. Even if you have a fair coin that's equally likely to land on heads or tails, it doesn't mean every flip will alternate between the two. You could flip heads 10 times in a row, but it doesn't mean tails is due. Each flip is independent and has the same odds as the last. John's story is a stark reminder of the pitfalls of ignoring the importance of probabilities. It's a lesson in the dangers of trading without a proper understanding of the game of odds that is Forex. It's not about being right every time, it's about playing the odds over time. So, what could John have done differently? The answer lies in understanding the probability edge. You see, in the world of Forex trading, one of the most important concepts is the probability edge. It's what separates the successful traders from those who are left wondering what went wrong, much like our friend John. Now you might be asking, what's this probability edge? Well, it's the idea that while each individual trade is unpredictable, over a large number of trades, certain patterns can emerge. It's about playing the long game, not just focusing on the outcome of one trade. Imagine flipping a coin. Each flip is unpredictable, right? But if you flip that coin 100 times, you can reasonably expect about 50 heads and 50 tails. That's probability at work, and that's the same principle you apply in Forex trading. So, the probability edge doesn't guarantee success on every trade. Oh no, far from it. But what it does do is increase your chances of overall success. It's about making the odds work in your favor, not against you. You see, John made the mistake of treating each trade as a do-or-die situation. He didn't understand that success in Forex trading isn't about winning every trade, but about winning more than you lose over time. It's about having a positive expectancy. Understanding the probability edge could have changed John's trading journey. And it can change yours too. Remember, it's not about the short game, it's about the long haul. Mark Douglas, a renowned trading psychologist, has a lot to say about probabilities in trading. His wisdom, cultivated through years of experience and observation, shines a light on the often misunderstood world of trading probabilities. Douglas's theories pivot on one core principle: trading is a game of probabilities. He argues that each trade is merely an individual event in a sequence of events, and each event is statistically independent. This means that no matter how many times a coin lands on heads, the next flip is always a 50-50 chance. It's a hard pill to swallow, especially when you've been on a streak, but it's crucial to understanding the volatile nature of the market. Douglas also emphasizes the importance of managing risk. He believes that by accepting the risk inherent in each trade, you're more likely to make clear-headed decisions. Furthermore, he preaches the development of a disciplined approach to trading. This involves setting a plan and sticking to it, regardless of emotions or market noise. Now imagine if John had applied these principles. Instead of chasing losses and spiraling into a cycle of poor decisions, he could have managed his risk, stayed disciplined, and kept a clear head. He could have seen each trade as a separate event, not allowing the outcomes of previous trades to cloud his judgment. Douglas's theories could have been the guiding light in John's dark tunnel of trading failures. So, what lessons can we learn from John's story and Douglas's theories? Well, John's journey in the world of Forex trading was a roller coaster ride. It had its ups and downs, twists and turns, but the most notable thing about his journey was not the highs or the lows but the lessons he learned. Lessons about the importance of understanding probabilities in Forex trading. This brings us to Mark Douglas and his profound theories. Douglas emphasizes the importance of probabilities over predictions. He tells us that we can't control the market, but we can control our reactions to it. We can make informed decisions based on probabilities, not on hunches or guesses. So, the takeaway here is to understand the role of probabilities in Forex trading. It's about making informed decisions based on statistical likelihoods, not on gut feelings or predictions. It's about being smart and strategic in your approach, not reckless or impulsive. Remember, in the world of Forex trading, probabilities rule, not predictions.